Live from New York City this morning. Good morning, good morning. After the biggest one-day pop on the S&P 500 since June, let's see if we can make this a 4-day rally. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg The Open with Jonathan Ferro.
Live from New York, coming up, jobs data in the US providing a gift for the doves as inflation in Europe opens the door for another hike and China's stimulus plans fall short of expectations. We begin with the big issue, fuel for the doves.
When you look at the data,
the JOLTS data,
the drop in consumer confidence,
there are a lot of indications that conditions in the labor markets are cooling off a bit.
We're starting to hear a little bit more in terms of softer employment.
The question is this the data point that Fed needs to get near the end of the tightening cycle?
I think we are seeing enough signs of slowing growth.
We have more confidence that the Fed is done with their tightening cycle.
A little more comfort that maybe they don't have to necessarily hike again.
Feels like the Fed should be done.
The Fed will pause.
Pause in September.
And now it's getting into that, how long do they pause before we start cutting?
The jury's still out as to the ultimate direction of the economy. And labor, for that matter.
We have to look at everything.
Let's wait and see how the incremental data points come out.
Joining us now is JP Morgan's Kelsey Barrow, Krishna Mamani of Lafayette College. Kelsey, first to you, and great to see you both. Are we making sufficient progress in this labour market?
We do think we're making sufficient progress in slowing demand and improving that imbalance between labor market demand and supply. So I think there was a key data point, of course. It's been covered now for over a day, which is the JOLTS report. The things that caught my eye were particularly the quits rate, which is now back to pre-COVID levels. We found that that has a fairly high correlation with wage growth. So wage growth is coming off the boil. Also, the hiring rate is down to the lowest level since January of 2018. So not just back to 2019 levels, but actually weaker than that. And this is really what we've been anticipating within our call, expecting that the labor market was weakening beneath the surface, that we would see it more explicitly in the headline data as the year progressed, and this would allow the Fed to be able to pause at this level of the Fed funds rate.
Job openings down, quits rate lower, ADP report downside surprise for whatever that's worth. Krishna, how thin is the line between progress and undesirable deterioration?
Well, so first, let's kind of talk about progress for a second. So we have been making progress on the inflation and wage and employment front for quite some time. Things have been slowing. But the real question, right for now anyway, is are we slowing down fast enough? And I don't think, we are slowing, but I don't think we are slowing down fast enough for us to feel comfortable that the pause is not going to be a very extended pause. Having said that, I think it is also worth remembering that in the first half of this year, a whole bunch of things came together to provide the impetus to the growth outlook for it to be extraordinarily better than what we were expecting beginning of the year. I think there is a good chance that things reverse. And but that reversal probably doesn't come in the third quarter. We will probably see signs of that more likely in the fourth quarter, or even more likelier in 2024.
Krishna, it sounds to me like you think there's maybe some more work to be done, though, from the Federal Reserve before we get to that point. Are you anticipating another move from them, perhaps potentially in November?
I still think so. I think the JOLTS report and everything else is helpful, but I think we have lots of other data points that are probably going to take them on the other side, CPI being a prime example of that. And if you look at the Cleveland Fed nowcast, it's definitely pointing upwards rather than lower. I don't think they singularly focus on that. So September is probably not in play, but saying that November is totally out of the picture, I think maybe a little premature.
The Doves have a better hand, I think, in the minds of many, going into that FOMC meeting on the 20th September. Kelsey, where will they be in November?
We think that they will still be on hold. And the reason for that is when we look at the trajectory of the data, the totality of the data, first inflation, then labor market, and then secondarily the GDP data, we think that they are going to be getting confirmation that policy is sufficiently restrictive. And to start off, it really all starts with the inflation data. We think inflation is slowing, and when we look at what's coming in the pipeline, we think that there's more disinflation to come. There's one index that has not really gotten a lot of press recently, but the Cleveland Fed has a rental index, repeat rental index for new tenants. That just turned negative year over year for the first time since 2010. So it didn't even turn negative during COVID. And so the reason I bring this up is a lot of people are talking about the rebound in home prices as being this signal of the fact that policy impact is behind us and that we could be seeing this rebound in the housing market. We would really push back on that. First of all, the housing prices are not a direct input into CPI and PCE. But secondarily, when we look at the activity measures, the Fed can't control supply. What they can control is demand. And boy, have they done a good job stifling demand for mortgages. Mortgage applications are at 2-decade lows. Mortgage rates are at 2-decade highs. Mortgage affordability, home affordability, is at the lowest level since at least 1984, according to the National Association of Realtors. So I think what we're seeing is fairly clear in terms of the trajectory of the economy, that they won't need to do another rate hike in November.
Kelsey, there's a ton of people who think they've done a terrible job when it comes to the housing market because they're on the wrong side of it right now. I'm one of them. Krishna, do you think we can ignore the house price data given how distorted that market is?
Well, so I think you can't ignore house price data. I think house prices are very, very high, and they are unlikely to come down anytime soon. And this is something that we will have to deal with for quite some time. I think the key point here is new construction is still quite robust. And that matters for activity far more than mortgage applications for resales and things like that. So I think the housing market, the housing affordability is a long-term problem for the U.S. economy. But for now, new construction remains supported. The point in all of this discussion isn't, are we making progress? Of course we are. That's why we expect things for the Fed to pause. The question really is, are we making progress fast enough to what they have articulated, what their long-term target is, which Powell reinforced at Jackson Hole, which is 2%. And if that is the North Star that they're shooting for, then it is very unlikely to see that this pause ends up being a short pause. I think for it to be a short pause, a lot of things have to together start slowing down. It may happen, but it doesn't look like that right now.
Yields lower this morning, right now, down by 5 or 6 basis points, 4.84 on a US 2-year. We had 6 consecutive sessions of closing above 5% on a 2-year. That ended yesterday with a breakdown off the back of recent data. Yesterday, job openings. This morning, that move encouraged again by what we had from the ADP report. Tomorrow, jobless claims. Friday, we get payrolls. Mike McKee has more. Morning, Mike.
Good morning, John. Well, ADP does come in a little bit lower than expected, but much higher than it has been in recent months. 177,000 jobs added to payrolls, according to the payroll processor. But take a look at the chart. And here's what's interesting about that. Look on the left-hand side, the blue lines. That's non-farm payrolls, private sector jobs, which is the equivalent of ADP. And for the last year or so, they were running stronger than ADP. But in the last 4 months, ADP has come in higher than non-farm payrolls, which creates perhaps a risk for Friday in terms of private sector job creation. We also got GDP today. GDP revised down just a little bit to a 2.1% from 2.4%, still maybe above trend growth. But the contribution was all in consumer spending this time. Consumer spending added 1.1% and business spending 0.8%, while inventories and trade subtracted. If consumer spending remains strong, that augurs well for the third quarter, and we will get a consumer spending report tomorrow for July, the first month of that third quarter. The road ahead is going to be long. September September 20th is the next Fed meeting, and as you can see, we get a jobs report, PCE and CPI, same thing before November. So if nothing really changes in the data, we may have a pause in September, but there'll be a lot of data for the Fed to consider for November, and that could be, if we see a rebound in prices, that could be when they make a decision to raise rates again.
Mike McKee, thank you, sir. This narrative, oh yeah, just whipsawed from one narrative to another. It could change again on Friday with the payrolls data. Mike, thanks again. Mike McKee there on the latest economic data, looking ahead to the Federal Reserve and payrolls on Friday. Kelsey Barrow, I caught up with Ian Lingen of BMO in the last couple of hours, and I said, is this Treasury market for you, given what he was telling me about the economic data, a screaming buy? And he said the 10-year was a screaming buy. Kelsey, do you agree with him?
We do think that there is value in fixed income at these yield levels, and we do find it encouraging that we did test the highs reached in October of last year on the 10 and 30 year, which were 4.33 and 4.42 respectively. It was an uncomfortable ride, but we have rejected those levels and we are finding support. And when I look at the performance in the Treasury auctions specifically, the non-dealer takedown is very, very strong. So I think that there are a lot of people who are looking at this market and are saying, these are the highest real yields in multiple decades, and this is really an attractive time from a risk-reward perspective to be investing in fixed income.
Krishna, you said repeatedly over the last few months on this program the pain trade was higher yields. Are you sticking with that view?
Yes, for now, I'm sticking with that view. I think 4.5 is probably the upside range in 10 years. So the point about whether treasuries and fixed income are good value or not, they certainly are. I think from let's say a 2, 3, 5 year investment horizon, can we look at these treasury levels and say that things will work out really nicely? I totally agree with that. The challenge is they can become better value if they go to 450. That's really the point. It's a trade rather than a long-term valuation judgment on 10-year treasury. At the current levels, they're very attractive for sure for long-term investors.
Well, Kelsey, it's good news. Krishna's got some bonds to sell. We're making a market here. Kelsey Barrow, Krishna Mamani, sticking with us. Your equity market on the S&P 500 just about positive by 0.1%. 3 days of gains on the S&P, looking to make it day 4 with some price action going into the opening bell. Here's Simone.
Yeah, even though futures pointing modestly higher, most of the biggest movers are on the downside. One that's up, though, is NVIDIA. This may be on the back of some Bloomberg reporting about some of the analyst estimates here. Rosenblatt Securities' Hans Mosesmann now has a price target of $1,100, up from $800. That would indicate a market value of more than $2.7 trillion. And, of course, those shares just at $491, so a big upside. To the downside, HP setting up its largest loss in about a year after earnings yesterday. The company cutting its full year outlook. The message, rebound in the market for PCs is going to take longer than anticipated. And one that's really interesting as well, Brown-Forman Corp. So this is the parent of Jack Daniels and Woodford Reserve. It posted a surprise quarterly profit decline, but did maintain its full year outlook. It said whiskey sales fell slightly, but the good news was in tequila, up 15% year on year.
That's always good news. Simone, thank you. More from Simone around the opening bell. Coming up, Eurozone inflation leaving the door wide open for another hike.
To the ECB, we've always said that they've been behind the US. I think that you've got another rate hike coming out of the ECB, particularly given what you've seen on the inflation side coming out of parts of the euro area.
That conversation coming up next.
To the ECB, we've always said that they've been behind the US, have been watching what the US is doing. They're also being data dependent, just like the US Fed. And I think that you've got another rate hike coming out of the ECB, particularly given what you've seen on the inflation side coming out of parts of the euro area.
Inflation prints out of Spain, out of Germany, showing consumer prices still heading in the wrong direction. The data is just the first in a string of Eurozone reports that will dictate whether ECB officials raise interest rates in a couple of weeks' time. Maria Tadeo joins us now for more. Morning, Maria.
Good
Good morning. And look, this is a mega data-dependent central bank. So let's get into the data that we got today. When you look at Spain, inflation came in at 2.4% in August. It was in line with the estimate, but it did pick up from the previous month when it was 2.1%. When you look at Germany, again, this is the biggest economy driving the euro. You have inflation at 6.4% in August. The estimate was for 6.3%. So economists were expecting a faster cool down. Now, of course, we should make it clear we're waiting for the French CPI, the Italian CPI, and of course the big euro area number for August. But again, if you assume this trend will continue, if inflation either stuck or actually ticking up, you could argue it brings back fully on the table that September rate hike. Because remember, the ECB said they could hold or hike. It would depend on the data. But the fundamental question for the central bank is not whether inflation is cooling down or not. We know it is. It's whether inflation is cooling down enough to merit a pause. Now, if you get that kind of inflation numbers, that trajectory is still strong, then you could argue there is a strong case now to keep that hike going into September.
Maria Lagarde, Christine Lagarde, the ECB president, super vague with TK on Friday in that interview in Jackson Hole. What are other officials saying about incoming data and what they want to see happen in a few weeks' time?
Yes, and look, there's a number of reasons why she does that. Obviously, she's repeated this is a central bank that is guided by the data. Maybe it would have been a contradiction for the head of the ECB to swing either way without the actual prints from the euro area for the final August print before that decision, which will really be that final data point before they head into deliberations. Obviously, we know she's the head of the governing council, so she's supposed to be the one that brings in consensus or not take strong positions either way. Nonetheless, we do know from a number of central bankers, including the Germans, but also the Austrians, suggesting, yes, it's the data that matters. But again, the data would show whether or not we've done enough to really show the data is consistent with a cool down that would bring inflation back to target. So if you assume, and you listen to Nagel of the German central bank, you listen to Holtzmann of the Austrian central bank, they would say, looking at this data, it is still a good reason, or there is still a good reason to go for another hike in September. Maybe not convinced that this trajectory is moving as fast as the European Central Bank wants it to be towards that target.
Maria, thank you. The latest from Maria Tadeo out of Brussels today, heading over to Frankfurt, Germany on September 14th for that ECB rate decision. We've had a breakdown from the likes of Spain, Germany. Tomorrow, it's the headline Eurozone read for inflation, CPI, headline and core, coming tomorrow morning. Kelsey Berrow, we talked about the door being closed potentially for the Fed to hike in September. Is the door open for the ECB?
Well, the door is probably still open, but really only marginally so. We think that the ECB is in a really tricky place because when we look at the survey data and the activity data and the PMIs, and the ZEW, they're really all very, very weak. And so I'm surprised that we're not hearing more about the word stagflation in Europe. I mean, they still have a lot of inflation, but growth is definitely on a rickety path right now, I would say. So the ECB is probably going to want to bide as much time as they can, maybe skip in September, continue to remain data dependent. But when we look at the fundamentals on the growth side, it's not looking great there.
Krishna, stagflation, is that the right word to use to characterize what's happening in Europe right now?
Yes, I think, and Kelsey is absolutely right. Between the jobs of ECB and Fed, the Fed is in a significantly better position. The challenge for the ECB is the growth outlook remains extraordinarily weak. And inflation is slowing down, but not slowing down fast enough. And so what do you do about that? And I think my sense would be that to maintain their credibility, and I know it's a strange word to use these days, to maintain their credibility, they probably end up doing something rather than not doing something.
Krishna, how does a bond market trade in a stagflationary world? What do bunds look like? What do BTPs look like, Italian bonds? How do those bonds trade in that kind of world?
Well, so my expectation would be that stagflation would really be a temporary situation rather than being a long-term problem because of structural reasons. So if that is the thesis and if that holds up, I think the bond market trades just fine. It may not do very well in the near term because of inflationary pressures, but from a longer term perspective, the growth outlook is, given all the issues that your Eurozone faces, the likelihood that the growth outlook improves meaningfully and inflation remains as elevated for a long period of time, I don't think that's that's a possibility. So it should trade fine. It's just that there'll be a digestion process along the way.
You've got to throw in the China slowdown into the mix as well. A range of efforts over the weekend to try and do something about this equity market, cutting stamp duty on equity trading for the first time since 2008, stock purchases, leaning on some funds to buy equities, buy more than they're actually selling to try and put a floor under that market, cutting mortgage rates, deposit rates, all of these efforts, Kelsey Barrow, to stimulate the Chinese economy. Europe's got to confront that as well. You said the Treasury market was a screaming buy. You said that about 5-10 minutes ago, agreeing with what Ian Lingen of BMO had to say. Can you say the same thing about the European fixed income market?
We do think that ultimately this challenge that the ECB is facing is going to be reconciled with slower inflation and slower growth. So as Krishna mentioned, this is a temporary situation. And so ultimately, Europe is going to be another area where we can be diversifying our long duration position, not just in the US, but also with boons. I think you made a good point in terms of the situation with China. That is going to have bigger pass-throughs in Europe than it is going to in the US. But the one thing that we have been highlighting is that emerging markets outside China are actually holding up quite nicely. And one of our top trades for the year was EM local debt. And we've seen a lot of satisfaction there because the disinflation story in emerging markets has generally come out as anticipated, and you have emerging markets that are actually starting to cut rates. They started hiking ahead of the Fed, ahead of the ECB. They're now actually starting to cut rates. So there's opportunity to be long fixed income in multiple marketplaces right now, not just the US.
Kelsey, will you do me a favour? Can you tell Bob it's rude to make you work on your birthday? Okay? Tell him from me. Happy birthday. Kelsey Barrow, Chris Mamani, to the two of you, thank you. Going into the opening bell, about 7 minutes away from that opening bell. Equities just about unchanged on the S&P. Your morning calls are up next, and later, Keith Lerner of Truist on why investors shouldn't fear the recent equity pullback. Five minutes away from the opening bell, equities just about unchanged on the S&P. That's the price action. Here are some morning calls for you. First up, Bank of America raising Alphabet's price target at 146 from 142, seeing cloud and AI projects as positive drivers. Next up, Bernstein downgrading Texas Instruments to underperform, seeing gross margin expectations appearing, quote, far too high. And finally, Wedbush raising its Best Buy price target to 82 from 72, citing recent earning results that topped expectations on the top and bottom lines. Coming up, Keith Lerner of Truist on why he views the recent market pullback as a healthy reset. Your opening bell up next. Five minutes away from the opening bell, equities just about unchanged on the S&P. That's the price action. Here are some morning calls for you. First up, Bank of America raising Alphabet's price target at 146 from 142, seeing cloud and AI projects as positive drivers. Next up, Bernstein downgrading Texas Instruments to underperform, seeing gross margin expectations appearing, quote, far too high. And finally, Wedbush raising its Best Buy price target to 82 from 72, citing recent earning results that topped expectations on the top and bottom lines. Coming up, Keith Lerner of Truist on why he views the recent market pullback as a healthy reset. Your opening bell up next. So far, so good on the data front. 3 days of gains on the S&P 500. Longest winning streak of the month so far. Biggest day of gains yesterday for August. Biggest day of gains on the S&P 500 going back to early June. Right now, futures totally unchanged on both the Nasdaq and on the S&P 500. Let's the opening bell, switch to the board and get to the bond market. Yields shaping up as follows on a 10-year. Yields lower by a couple of basis points. 4.0983%. In the last week, I think just last Tuesday, we were through 4.35. in the 430s, all the way back down to about 4.1% on a 10-year this morning. In the FX market, dollar weakness, euro strength, 109.27, positive on that currency pair by 0.4%. And in the commodity market, a lift here of 55 cents, up by 0.7% to $81 and about 71 cents. About 30 seconds into the session, advancing here by 0.1% on the S&P. On the Nasdaq, up by almost exactly the same amount. One stock to watch at the open, HP. The company reducing its full-year cash flow and profit outlook. The CEO saying this: while we expect another quarter of sequential growth, the external environment has not improved as quickly as anticipated, and we are moderating our expectations as a result. Simone has more. Hey, Simone.
Hey, John. Yeah, this is the biggest loss since last August as the company cutting its full year outlook. Analysts had been looking for some sort of sign that there was stabilization in the consumer electronics market, but they in fact particularly called out a bunch of the weakness in the enterprise space around printers. Seeing net revenue down 9.9% year on year, that was more than anticipated in the last quarter. Trimming that full year profit forecast, as I mentioned, now $3.23 to $3.35 per share. They had seen $3.30 to $3.50 per share. The Wells Fargo talking about how there was structural demand and competitiveness issues, calling the outlook for the company particularly bleak. The CEO there is still confident that a rebound will happen, but certainly less accelerated than they expected a quarter ago, John.
Simone, thank you. The stock's at 28. It's down 9%. Deutsche Bank lowering the price target on HP to 28. That's where we are right now. They've gone down to 30, citing weaker demand driven by slower recovery in China, elevated channel inventory in PC, and cautious enterprise spending. Have they lowered that price target enough? Right now, 28, 29. Their price target is 30. I want to turn to EV. Tesla facing increased scrutiny from federal regulators over its driver assistance system known as Autopilot. One agency saying Tesla has introduced a configuration that, when enabled, allows drivers to operate their vehicles for extended periods without it prompting the driver to apply torque to the steering wheel. Ed has more. Morning, Ed.
Yeah, good morning, Jonathan. Tesla down more than 1%, but remember, it closed up more than 7% yesterday, its biggest jump since March. Remember, NHTSA's had a probe on Tesla's Autopilot since 2021. This particular inquiry from the regulator, the National Highway Traffic Safety Administration, relates to a report back in June that there was a specific setting on Autopilot that simply allows the driver to maintain hands-free without applying a periodic pressure to the steering wheel, something which is not, frankly, permitted in at least the United States. We know that Tesla responded to that NHTSA request for information by NHTSA's deadline, but it was in confidence, so we don't know what Tesla had to say. You know, there's a lot of focus from a regulatory perspective on it, simply because Tesla is a technology leader. And, you know, there's momentum around autonomous driving technology, but the regulatory scrutiny is essentially a headwind to growth, right, and continuing to monetize that product. Separately and kind of more broadly, as these UAW discussions continue with the Detroit 3, our colleague Joel Levington on the credit side at BI has a really interesting note out about how Tesla could use the opportunity of that chaos to continue using price cuts as a lever, because it's immune to what's happening in those UAW discussions. So I just want to point that one out as it's some good reading this Wednesday morning.
Yeah, well flagged, Ed. Just where are we right now with those negotiations going into the end of that contract next month?
Yeah, look, simply put, the UAW is going to the automakers and saying, hold on, how can you in good conscience say you cannot afford our demands when you are combined spending as an industry $100 billion to electrify your product line? Their basic argument is that the capital commitment that the automakers have made to transition to EV is at a similar scale to what they're demanding in terms of pay increases. So, you know, negotiations ongoing, but I think what they're looking up for, a 45% rise in wages, the automakers come back and say, not right now.
Ed, thank you, sir, for the update. Ed Ludlow from the West Coast on the automakers and Tesla specifically there. About 4 or 5 minutes into the session, day 4 4 of gains on the S&P, up 0.2% on the S&P. I want to turn to crypto stocks. Coinbase in focus after Grayscale won a key legal fight in its push to launch the first spot Bitcoin ETF. Grayscale saying this in a statement: "This is a monumental step forward for American investors, the Bitcoin ecosystem, and all those who have been advocating for exposure through the added protections of the ETF wrapper." Katie tracking the story. Morning, Katie.
Morning, John. Yeah, Coinbase shares currently wavering this morning after a 15% rally yesterday. Like you said, that follows news that an appeals court sided with Grayscale in their lawsuit against the SEC. That was seen as a big step forward in the path to a U.S. spot Bitcoin ETF. And that matters for Coinbase, given that in addition to being a crypto exchange, how you probably know it, Coinbase is also a custodian for Grayscale's Bitcoin Trust. It's also lined up to service a number of the active spot Bitcoin ETF applications currently in the SEC's queue, including BlackRock's application. Now, the custody business has been seen as a bit of a silver lining for Coinbase here, given that its crypto trading volume has fallen off a cliff and stayed there over the past year or so. There is debate as to how much that institutional business can really buffer the bottom line if we do see volume continue to remain muted. But even with those question marks, Coinbase shares up almost 140% this year alone, John.
What a move. Katie, thanks for the update on that story. Just a programming note to continue this conversation. Next hour, 10:45 Eastern Time, so about an hour from now, actually, the Grayscale CEO, Michael Sonnenschein, speaking to Bloomberg's Sonali Basak. Don't miss that conversation a little bit later this morning, 10:45 Eastern Time. I want to turn to the chip makers. NVIDIA announcing a new partnership with Google Cloud that could expand distribution of its AI technology. The CEO saying, quote, "Our expanded collaboration with Google Cloud will help developers accelerate their work with infrastructure, software and services that supercharge energy efficiency and reduce costs." Isabel Lee has the story. Hey, Isabel.
Hey, John, investors definitely took that as good news. The stock closed at a record during that data it was announced. But as you can see, the stock is now kind of flat. But still, even if NVIDIA's spectacular rally has slowed somewhat, we have a lot of investors still bullish on the stock. In fact, there's one I want to bring your attention to, Rosenblatt Securities. So they increased their price target of NVIDIA from 800 to 1100. And if achieved, this would make NVIDIA's market value up to 2.7 trillion. That would rival Apple's 2.9 trillion. So Rosenblatt said NVIDIA is just getting started. He's really raising it on the back of expectation that NVIDIA will increase supply in each quarter through next year. NVIDIA is up some 234% year to date, and it's by far the best performer in the S&P 500. But not everyone is as bullish. Out of the 60 analysts Bloomberg surveys, we have 4 who are rating NVIDIA as hold, John.
Isabel, thank you. That stock, a ridiculous run through 2023. Your broader market slightly positive on the S&P, slightly negative on the Nasdaq. Keith Lerner of Truist given his perspective on markets over the last month, saying August has been less friendly to investors. Our view is simply that after 5 straight months of gains, the market became overextended on a short-term basis. We view the recent step back as a healthy reset of expectations. Keith, I'm pleased to say, joins us now for more. Keith, August, you say a tough month. I had a guest earlier this week called September a slippery slope. Would you push back against that, Keith?
Well, historically, that's right. I mean, the seasonal trends tend to be negative in August and September. There's only one thing to look at, right? Seasonal trends, but we will get into, I think, a lot more, news from Washington as we think about a government shutdown potential as well. So I still think it will be choppy. But going back to the border point, Jonathan, which you just alluded to, is that we did have these big gains coming into July, and what we saw is that expectations had risen, right? The bar for positive surprises had risen quite a bit. And we saw sentiment become much higher as well. So our view coming into August was that it was going to be a choppy period and likely to see some type of corrective period. But the good news, in our view, we published a note last week calling it a healthy reset, in that we've seen sentiment come in on many of the metrics that we look at. We've seen that as the market has come down before the last couple of days, the earning trends for the market is now at a 52-week high. So we think that's a positive as well. And overall, I think the economy is still proving to be somewhat resilient near term. So overall, I think you got to respect the trend. And the last one I'll say, from a technical basis, you came down towards support, you came down to an oversold condition, and you bounced. So that's a healthy sign that you want to see on pullbacks.
Keith, let's talk about the data and whether the progress we're making is healthy or not. We had job openings yesterday come down, quits level drop. This morning, ADP downside surprise. Tomorrow claims, Friday payrolls. The 13th, we get CPI, the 20th, the Fed decision. Do you think we're making progress quickly enough? Krishna Mamani in the last hour said we're not. Do you agree with him?
I think we are making pretty good progress, especially relative to our expectations coming into the year. If you think about like the ADP report this morning, let's say the Friday print is around the same level, 175. I mean, obviously it's a wild card. But if you go back to 2019, the average job growth that year was about 160,000. So, we're in this tricky part where you're coming down from really elevated levels and you're normalizing the data. I think the concern at some point later this year is if it starts to come down too quick. But right now, I mean, the way we're looking at it is at least short term, it's more of a normalization. And 175,000 payroll is still enough to keep the unemployment rate relatively low.
Well, Keith, I mentioned that a little bit earlier. Let's really try and paint that picture with some detail. How fine is that line between progress and undesirable deterioration? How fine is that line?
Oh, it's a fine line, Jonathan. You think about when people, this debate around economic growth right now, if you're looking at manufacturing data, leading economic indicators, the yield curve, everything there points towards a recession. You look at unemployment, initial claims, the services side is still showing relatively strong. We all know the Atlanta GDP, which is overstated. You guys talked about it this morning, is around 6%. So I do think as we go later in the year, what's going to cause a different market than the first half is that fine line is going to show like some data points are going to confirm that the economy seems fine. And then we're going to see other data points that show the opposite. So I think that's going to just lead to a much more choppier market. And I think from our perspective, the way to deal with that is you buy oversold conditions. And if you're being more tactical, you sell the rips in some ways as well.
Let's pick a sector. I'll paint a really bearish story for you, and you can tell me if you're on the other side. Consumer confidence down, jobs market easing, retailers, pick any retailer right now. I can give you a bunch of them warning about something. There's a long list of things they've been warning about, Keith, over the last week into the rest of this year. Keith, what is there to like about consumer discretionary with all of that going on?
Yeah, so it's an interesting sector because consumer discretionary, when you look at what's actually driving the biggest names in there, it's like Tesla and Amazon. So I call it a quasi-growth sector. So I think those growth areas are the areas that we still like. But to your point, it's very bifurcated. And I don't think those other areas that you mentioned are going to be leadership. I mean, I do think we're going to see some slowing in the economy. I do think the lagged effect will hit at some point. And by the way, the Fed just put out a new study this week that suggested that the lag for corporate interest rates hitting, works with about a 5-quarter lag every time you raise rates by 100 basis points. So I think we're going to see more of a hit there, especially as some of the excess savings as well for the consumers. But I would focus more on the growth side of consumer discretionary, just like, another area that we like is communication services, which is also more of a growth area as well.
Keith, can I squeeze in energy as well? One of the rare sectors this month, so far month to date, that's actually positive through the month of August. Last time I checked yesterday evening. This is all happening, even with this slowdown in China and seemingly their inability or unwillingness to respond to it with force at the moment. Keith, what's driving that story for you?
Yeah, it's interesting. All the points we're talking about is this bifurcated overall market, and also like the traditional playbook isn't working right now. But going specific to energy, we went negative early in the year. We upgraded to neutral. I will say the overall trends are somewhat improved. I think the supply cutbacks is a positive. And the other thing, a lot of these companies have a lot of good cash flow generation. So we also have to remember last year was a big year in energy. A lot of people were very bullish. You're working off some of that bullishness now. So we're not overweight yet, but we're watching it closely for an upgrade. We're just being patient at this point.
Keith, appreciate the patience and the update as well. Keith Lerner of Truist on the latest. Thank you, buddy. It's good to see you, sir. About 13 minutes into the session, equities up by 0.2% on the S&P 500, potentially fourth day of gains on the S&P. That would be the longest winning streak going back to the middle of July and follows the biggest day of gains since early June on the S&P 500. Coming up, Secretary Raimondo talks business in China as Huawei-Apple competition ramps up.
The U.S.-Chinese economic relationship is large, vibrant, and dynamic, and that benefits both of our countries and economies, and that benefits the world. There's business we can do, and there's business to be done.
There is business to be done. Your team coverage up next.
There's business we can do, and there's business to be done. U.S. businesses want to do business here, but they need to have a predictable regulatory environment. Nothing good comes from shutting down communication. What comes from lack of communication is misassessment, miscalculation, and increased risk. Nothing good comes from decoupling.
There is business to be done. Secretary Raimondo in Shanghai pushing for a stronger regulatory backdrop in China. This on the heels of Huawei's surprise release of its new smartphone, sparking hopes that Chinese firms can overcome US sanctions and curbs. The launch coming just weeks before Apple is set to unveil its iPhone 15. Your team coverage starts right now with Ed Ludlow alongside Anne-Marie down in Washington. AMH, just how tense are things right now between the Commerce Secretary and Chinese officials?
Well, she really tried to walk this fine line, Jonathan. We heard her say that commerce and trade could be the bedrock of this relationship, which potentially could help decrease the tension we've seen from Washington and Beijing, and also provide opportunities for the Chinese economy that looks like they would need it right now. But of course, when it comes to China, they are incredibly concerned about the export controls coming out of the United States. And it's her agency that is leading that charge. And then you wake up and you see what's going on with Huawei. Potentially, China is getting around some of these curbs that the U.S. has applied to it. I mean, Huawei has been on the entities list during the Trump administration since 2019. So how are they able to potentially get this technology while there are sanctions on that company? That is a question, and that is why it's also very awkward that this phone came out and was launched seemingly today, and she's headed back to the United States.
This is fascinating. Breathe some life into this conversation. How much competition might there be for Apple domestically and beyond?
Great setup by AMH because it's a technology story as well. You know, unverified reports, and Bloomberg's not been able to verify them. I want to make that clear. But the Mate 60 has seen a number of Chinese outlets do teardowns, and they went right to the processor. The processor indicates that it was manufactured using 5 nanometer node technology. To the best of the industry's knowledge, China has itself not been able to crack 5 nanometer node technology, which is only one generation prior to the cutting edge, which is 7 nanometer, right? So the reason I say that is because it's been on the entities list since 2019. We know that Huawei had stockpiled TSMC built chips at the cutting edge. It raises a lot of question about how much progress they've been able to make, not just on their own chip design front. HiSilicon, their chip arm, is by reports the designer of this chip. But if they've been able also to work out the fab side of this equation, then you look at the stock reaction overnight across a number of Asian and Chinese suppliers, there is an indication that they'll be able domestically to make their smartphone market more competitive, which goes back to Apple, because Apple always sees China as such a key market.
So, Ed, how big is this iPhone launch in a few weeks' time?
Yeah, I think it's big. And you know, iPhone 15, as Mark Gurman always writes, you know, it depends generation to generation on the substance of the hardware upgrades. We expect big hardware upgrades. Think about the bigger picture here in Apple's most recent earnings. We know, Jonathan, that significant technology upgrades drive a refresh cycle, which is important for the company, but it is also important to spur consumer pockets of demand globally.
Ed, thank you, buddy, for the update. Ed Ludlow there and Anne-Marie. Fantastic setup from AMH, as always, on the latest between China and the United States. And a really fantastically interesting technology story on the tech front in China. I would say the competition for Apple domestically in China, what happens from here for them? Difficult, tough time for them with sales of the iPhone. Let's see if the 15 changes that. About 22 minutes into the session, equities up by 1/3% on the S&P, up by 1/4 on the Nasdaq. Let's lift the lid on the index, get you some sector price action. Here's Simone Foxman.
Yeah, tech has been so much of the story so far this year, but it is not the main story today. Energy, industrials, and healthcare leading the way when you look across the markets at different sectors. Energy, we've seen one of the two sectors that is positive on this month, with WTI largely flat since the beginning of August. We're watching financials here as well. This particularly after news that Visa and MasterCard are planning to increase fees that merchants pay to accept customer credit cards. Those are set to start in October, April, and will bring in about $500 million more in fees. But one I really want to highlight here is healthcare. Again, one of the two sectors that has been positive on this month. holding steady today, even though we had that news yesterday on the Biden administration and announcing 10 drugs on which it's going to negotiate drug prices with Medicare. But Eli Lilly there, I think that's the highlight for the month, among the best performers, over 20% up since the start of August.
Simone, thank you. Thanks for that. Looking ahead to next week, through the rest of this week, I'll bring you the trading diary. So far this week, so far, so good. Job openings aggressively lower. Then we had ADP, downside surprise. Tomorrow claims, payrolls on Friday. And when I say so far, so good, I'm talking about from the Fed's perspective. This is the outcome they want to see. Further progress to keep that door shut to further hikes on September 20th. Your trading diary up next. It's 25 minutes into the session. Yesterday, biggest day of gains on the S&P since early June. Today, potentially a fourth day of gains on the S&P. Right now, equities up by 0.4%. As the price action, here's the trading diary. Coming up, home sales coming at the top of the hour on Thursday. Another round of jobless claims and the PCE deflator. Friday, the main event, the US payrolls report. And remember, Monday, US markets closed for Labor Day. Before we get to Monday, sneak peek of Friday, the estimates so far in our survey, the median estimate 170,000, just down from 187. From New York, that does it for me. Thank you for choosing Bloomberg TV and good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.